before we start? We've got options today. Well, you don't have options. We're going to talk about options, but we're going to discuss. So, one of our credit derivative instruments that we mentioned last time is an option. All right, so there are a couple types. One is called the American option. And so first of all, the option is an option to buy or sell at a future date in general. So option to buy or sell at a future date. And what makes it American is that this can be exercised at any time. So can be exercised at any time before expiration with an American option. European options can only be exercised on the delivery date or on the expiration date. Yes, yeah, that's the same for both. So the only difference is the timing of when you can exercise the option to buy or sell. Okay, so we got two types. The call option is the right to buy. Call option is the right to buy. And the put option is the right to sell. So calls and puts. Okay. Questions on definitions so far? All right, we've got a little example we're going through here. So suppose, here's our example. Suppose company Alpha has a current stock price of $50. So I'll draw just a quick little graph here, putting time on the horizontal axis and the price of alpha on the vertical. And then let's just go 10, 20, 30, 40, 50, 60, 70, 80. I think 80 will be fine. And I'm going to use 20 later. So alpha has been chugging along over time, and today, whenever that is, we just want a squiggly line to end up with right there. Michael? Phone? Sure what? So, suppose there's, of course, some uncertainty. With where this thing's going. And we're going to try to hedge that for tomorrow. And maybe it'll end up at 80. Whoa. So, if we think company Alpha is going to shoot up to 80, what would be our move? Buy a call. Or just buy it a long position, right? So buy low, sell high. So this is kind of our starting place just to think. We're going to go through a series of possibilities. We're going to get to a call later, but if we just feel pretty comfortable, it's going to go from 50 to 80. We could take a long position. And so if this is outcome possibility A, we can think about multiple end prices. So we're going to make a little table. End price of 80. And if we go long on the stock, we make 30 bucks. So we're up 30, just taking the 80 minus the 50. All right, so another state of the world that's possible is the stock falls to 20. So outcome B. So in this state of the world, the price in time period 2 for outcome B is 20. The price in outcome A was 80, and our initial starting price was 50. Okay, so if we would like to avoid this, but still have the upward potential, we can do our option. So somebody said call option. What's that? Don't do that?
That was me. Yeah. I'd want to go with buy, or you can buy now right along with it, put a put option on it, have the right to sell it 50 now. So you either gain the outcome A, or you and you end up getting that minus the gain to sell it at 50, or you end up at outcome B, outcome B.
Okay, hold on, slow down. So first of all, with the call option, why would we want to do it? If our initial thing is we think we're going to end up at outcome A, that's our most likely state of the world that we think is going to happen. So we could go with the long position, but now we're starting to think, oh gosh, you know, maybe there's going to be a war is going to break out, or somebody's going to hit the trade towers, or natural disaster, or whatever. Something, there's a possibility, even though we don't think it's likely, of getting to B. So if I buy a call option, what does that do for me? Okay, and so if it falls to 20, I don't have to exercise the option, right? So that's the benefit. We're going to get rid of that downward risk by buying the option, but it's not going to be for free. So we're going to have the call of the right to buy alpha in the future at this time period, and if alpha happened to go down, we'll just let our option expire. We just won't buy it. Whereas with the long position, we're locked in. If it goes down, we're going down with it. Right? We kind of take the ride along with it. So with the call option, we have some terms that we need to discuss that we haven't yet. So let's say that we've got a, let me squeeze this, well, I can put it right down here. So we got a call option, and its price of the option, price of option is equal to $5. And it has a strike price of 60. And the expiration, let's say, is 1 month from now. So maybe our tomorrow here is 1 month. Okay, so with this strike price innovation, it has to go up a certain level before we're in. So the strike price gives us this kind of threshold. We think it's going to go to 80 anyway, so I'm pretty comfortable putting buying $5 option with the strike price being 60. So if things work out and we end up with state of the world A here, then how much money did I make? 15. So we've got an $80 actual price. The strike price is the price I get to buy the stock at. And so I'm going to buy it at 60, sell it immediately for 80, making 20, but it's 15 because we had the option price to take out of it. All right, so with the call option, we end up making 15 bucks under that scenario, which is our $80 price minus our strike price of 60 minus our option price of 50. Five, sorry, yeah. I looked at that, saw 5, said 50. Okay, so downward direction. If the stock price ends up being 20, what did I lose on my long position? 30. 50 minus 20. So I'm out 30 bucks. And what did I lose on my option? 5 was the total cost. 0 might be one way of looking at it. That's not the answer I was looking for, but how could it be 0? Or you want to justify, there's a good economic argument that it might be 0.
Because you had no, like, are we talking opportunity cost?
Kinda.
Because
Talking more like marginal cost, but the opportunity cost.
Like the next best alternative, you lose $30. Is that
No. So Michael said, Chelsea said 5, which is the answer we're going to write here. So let me put -5. We're out our price, but I think there's an economic argument that it's really 0 a month from now. Doing that clever stuff that us critical thinking econ people do.
Well, the price of the option is a sunk cost.
Is a sunk cost, good, right? It's gone. You paid it. You're not going to be able to recover it. So once you've dropped the bomb on it, then really, what did you lose here? You really only lost you didn't lose anything because you could never recover it back. Good. So I thought I'd throw that out there. So, but 5 is what we're looking for as far as accounting cost of the transaction or accounting loss. You lost that 5. Start looking at it from the whole time frame of when you bought it to when you sold it. Okay, so up here, how much money did we have exposed to have the $15 gain? How much money did we have at risk? Just the 5, right? Yeah, because we paid out the 5, we put the 5 at risk, and then we had the upside of 15. So we paid 5 to make 15. Not a bad rate of return under those set of circumstances. With the long position, we paid 50 to get that 30. So we made more money, but the point here is that we kind of potentially put more at risk to do so. Katie?
If they, this might be considered wrong, but if they paid 5, wouldn't they only make 10 and then we're double counting the 5?
We took the 5 into account here.
There.
So you're right, but we did already take that into account here. They actually made 20. And then we subtracted off the 5. Yep. Okay, so here we paid 50 of our resources to get 30. So you see the leveraging potential here with the options. We can put a little less at risk perhaps. We're not making as much, so it might come down to how sure we are that it's going to go up. Okay.
So with the call, did you not initially purchase it today?
With this column, we did purchase it. We purchased the call option, which is a different financial instrument. Not the is that what you were asking? We did not purchase the underlying stock, just the right to buy the stock. Okay.
So that 50, like the $50 per share doesn't really come into your personal cost for.
That's right. It doesn't at all. All we did was we purchased an option, the right to buy it, which means somebody was on the other end gambling too, right? And that's where this whole, we're not going to get into those details, but somebody out there thought, no way, this stock is never going to rise above 60. I agree with you, it's going to go up, but it's never going to go above 60. And so you give me $5, that's kind of our bet.
This is a different market.
It is a different market, yeah. Yeah, this is different than the futures and the forward market that we looked at. So now we're dealing with the right to buy. We'll show later how they're connected. Now, if you think that the stock is more likely to come out with outcome B, what should you do? So I'm flipping it on you. Instead of thinking that the most likely state of the world is A, let's say that the most likely state of the world is B. We're going to stick with the options, and long or shorts. We're going to do a long or a short. What does it mean to do short? If we think something's going to fall in the future, we can short it. Right? What's that again? You can see we're getting kind of complex with this. Yeah, you sell it, but you don't have it. So that was the other set of notes that you had from before where we think it's going to fall, so I'm going to essentially sell it today by borrowing it from another investor. You're almost like renting it. And then when the stock falls, you're going to buy it back cheap and give it back to the original owner. Here's your shares of IBM. Here's your shares of whatever. I'll write that out here. So I think I'll start that here. So note, maybe I'll switch to blue. So note, if you think alpha is likely to fall in price, short them. And the short worked like this, like we were just saying, we're going to borrow the stock from somebody else. Essentially think of it like renting it. And we're going to actually sell it. Sell it for 50. I'm putting that in quotes. We really are selling it, but we're really obligating ourselves contractually to pay back the stock to the person we're borrowing it from. So we're going to sell it for 50, and then buy it back. Yeah, let me switch it. Buy it back for 20. And then after we buy it back, we're going to return it back to the owner and make our 30 bucks. So our next column, I should have told you how many columns we're going to have. You guys can start a new column. I'm going to try to squeeze it in here. If you take a short position, on the short, if the stock falls to 20, like we're hoping, we're going to make 30 bucks. If the stock ultimately rises and we get outcome A instead of outcome B, what do we lose? 30. So 30 bucks, right? So stock price was here. I borrowed it from somebody else. Prices rose. I had to go to the stock market and buy it back at 80, and now I have to repay it back. I end up losing 30 bucks on the short position. So what if the price of alpha, what if price rose to $800 instead of 80? What would happen besides possible suicide? Yeah, so we're talking big money. So the point that I wanted to raise here that's been talked about in different ways is that when you get into the shorting business, you have, there's endless risk potentially, or you are exposed to financial ruin potentially if it goes completely the opposite direction. Now, if you're pretty knowledgeable and there's like, oh, there's no way that the stock will ever do that, that's the game that you play, and you might be able to hedge that in other ways. Now that we've learned, you might be able to pick up some other instruments to take that short position and maybe offset it. But that's the problem. So you lose everything. Not really everything, but potentially. You lose big. And that's the additional risk with shorting. Okay, so what can we do as an option to minimize that huge potential loss if we're wrong? Put, good. So instead of actually doing this method, we can instead have the option to sell it. And that's going to minimize our risk. So with the put option,
This is the last one.
This is the last one, yeah, so if you can squeeze it in. It's kind of nice to see them laid out, is why I wanted to set it up this way. We have details similar to our call option. So you guys can write this below. It's not part of this table here. So let me just put the put option terms. So with the put option, let's say we've got a price of $5, and we have a strike price of $40, and the expiration, all important, having the deadline, of 1 month. So let's start with things working out the way we hope, that the price does actually indeed fall to 20. Outcome B, with the put option, how much money did I make? I bought the option for 5. It needed to fall to 40 in order to be in the money, which is a term that I hadn't talked about yet. How much? 15, right? So we got the strike price of 40 and the actual price is 20. I have the right to buy, I have the right to sell it rather at 40, and then I'm going to buy it back at 20 because the market's good. So I'm really just doing the same thing we did here with the short position, except now my effective price has become the strike price because I had to absorb that first downward momentum to get myself in the money. So we're going to have a positive 15. Which is the strike price minus the actual price in that state of the world minus the $5 that I had to pay for the option price, and I make 15. Yeah.
So are all call options going to be long positions and all put options are going to be short?
That might go beyond my expertise.
When we were in financial math, we did both on the long and short call and long and short.
Yeah, because I think you could reverse one the other direction. So I think I can't quite see that in my head to explain that better, but because the call is just the right to buy something, then I think that can go, the timing can be reversed. It doesn't have to be necessarily coinciding with the long position.
Can you explain the strike price?
The strike price is part of the strike price is part of the details of the financial security. So remember when the futures market we had 100,000 and it was the interest rate was fixed, like there was terms to it. Like what am I buying exactly? Well, this is what you're buying. You're buying the right to sell this security at $40. So we fixed it at 40 and it's going to expire in 1 month and you paid $5 for it. So if the actual price ends up being 40, how much money did we make? So instead of dropping to 20, if it actually just dropped to 40, how much money did we make? We still lost the option price, right? So in order to be in the money, what does the price actually need to fall to? 35. It's kind of our break even. And then all of a sudden we're in the money. Do you guys remember when I was trying to, I thought I had good inside information with the executives and told you that story with EAI. We did an option and I remember trying to get in the money. And like, oh, we're in the money. No, we got to do this to be in the money. So that's kind of a fun little Wall Street type thing that you feel like you're doing something. But at the end of the day, it's for my particular case, it wasn't really hedging. It was just nothing short of basically gambling.
Do you have a full month to exercise options?
Yes, yes. So yeah, with the
Why not do it in 1 day as long as you had a full month to...
yep. So with the American option, you could buy it before it expired. So once you knew you were in the money, maybe for some reason you wanted to, you had money that you wanted to get out the door for cash flow timing reason or something. Remember, because you got to buy these shares back, right? Because all you've shelled out so far is the $5. And what you're ultimately doing is you're going to be buying the shares back at the 40 or whatever, and that's going to be an outlay of cash. And so you can time it earlier if you know that you're in the money, or you want to, you just want to do that for whatever reasons. But with the European, you got to wait until that day.
So for the call option, when it's outcome A and it's 80, but the strike price is 60, why wasn't there a loss there?
Because at 80, we had the right to buy it at 60. And so the actual stock price was 80. I bought it at 60 and I made 20 bucks. Yep, that was this part that I kind of erased already. I should have. 80 minus 60 minus 5. Okay. Okay. So with the put, what do I lose if outcome A occurs? What am I out? Just the 5 bucks. And as we said here, as a side note, if this happened, we're still only out 5 bucks instead of multi-millions maybe. So we're out the $5. Okay, so looking at it this way, we kind of start to see there's people on each side of the transaction with all of this stuff, right? So for every person going long, there's potentially, well, there's got to be somebody probably going short. The broker's kind of trying to play both sides. The broker sometimes gets into putting their own money at risk if they think it is, and there's not enough shorters out there, then they might be making the deal happen, making the market happen. But otherwise, we've got people on both sides of the fence. Somebody's going to win, somebody's going to lose with these positions that we're taking. Now, somebody's going to win, or I got to be careful with that because that does make it sound like gambling, right? We're back to zero sum. How is it not? Let me throw that question back out to you. How is that not zero sum, or how could you characterize that really both parties are winning? Because in a free market system, I'd like to think that these two parties are engaging in this transaction, and they both potentially win.
I mean, should this not be an option for one, but should, like, if they were just buying outright, then the people that would lose on the option are only losing the $5, so they gain because it's available to them to actually not lose it by just buying outright or just going shorter or anything like that. And then the people that win still win a substantial amount of money. So losses are minimized and gains are, even though they're not as large.
Losses are minimized. Okay, so kind of before the fact. All right, anybody else want to jump in?
No, I just said you lose less.
You lose less, yeah, by doing this part, yes. Anybody else? So with this stuff, I think one win-win story is just that before the fact, we're trying to do something, and I want to be able to do that. Even if the outcome ends up meaning I lost, I'm still a winner because I got to play the game at all. Whatever was going on in my life, I thought that it was necessary for me to take a certain position to hedge risk of some sort. Otherwise, you wouldn't do it. So in that sense, again, accounting-wise, we might be a loser on paper, but maybe that afforded some other sort of not observable win that's going on in the marketplace. And we don't know all of the other reasons why we have this instrument over another one. Okay, so fundamental difference there with the hedging. So let me show you a graph that I apparently forgot my. This thing shut down. That's right. I'm gonna do I left my gizmo. I needed to do a PowerPoint. At least this graph. This work too. So, okay. Figure 1 from this chapter. What it's doing is laying out for us